It's the Nichols Tax Update Podcast for August 17th, 2020. This program is made available to you as a member benefit by the South Carolina Association of CPAs. It is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. And before we go too much further, I want to acknowledge the reliance that I place on tax analysts' tax notes today. Every item we talk about here, you can find discussed in more detail at Tax Notes Today. Let's start with final regulations on the state and local tax deduction limit. The Tax Cuts and Jobs Act includes a provision that's intended to limit itemized deductions for state and local taxes, the so-called SALT limit. However, in some states, you have programs designed to offer tax credits for contributions to charity in various forms that allow some taxpayers to avoid the full bite of the limitation by transforming contributions to charity into credits against state tax obligations. The trick comes in being able to make the case that a payment by a pass-through business entity to the charity had a business purpose. Here's an example right from the regulations. The state tax deduction workaround. Let's say that we have an individual taxpayer who's a partner in a partnership. The partnership pays $1,000 to a qualifying charity. Or let's say the partnership pays $2,000 to a qualifying charity, and our partner is a 50-50 partner. The partnership reasonably believes the payment will generate name recognition and goodwill. Now, I don't reasonably believe that instructing my partnership to give $2,000 to the Westminster Presbyterian Church is going to generate name recognition and goodwill for my business. But if we make a contribution to the Ronald McDonald House, we get our name in the newspaper, and that's be really good. So the partnership makes a contribution to a charity that is public enough that we get some name recognition, and now the partnership converts that charitable contribution to a state tax credit. But the partnership doesn't pay state taxes. So it passes the credit through to the partners. I'm a 50-50 partner. I get half of the $2,000 credit, $1,000, a credit against my state income tax. I get it on, it's reported to me on a K-1. I'm not required to inquire into the background of the credit or where it came from or how we come to have it. It's just $1,000 tax credit on my K-1. The community benefit may be lost in the transaction, and even if the IRS, even if it's publicized, it still may be a hard sell. I'm not particularly enamored of the SALT workaround, but if that's the best you got, that's what we'll do. Now we have a bad debt deduction denied in VHC Inc. The Seventh Circuit on appeal has affirmed a decision of the tax court that $92 million advanced to various business interests of the son of the founder of VHC Inc. over a period of 11 years could not be deducted as a bad debt. Might be treated as a capital loss, but certainly not deductible as a bad debt. Before a business can claim a bad debt loss, there must be bona fide, which is a fancy word for genuine, debt, establishing a debtor-creditor relationship. The characteristics or attributes of debt are well established in the Seventh Circuit by its decision in Busch versus Commissioner in 1984, where it articulated the attributes of debt. This successful family business, over a period of 11 years, advanced over $90 million without any investigation of his creditworthiness, without ever seeming to think about, well, you haven't paid us back the last advance. Why should we advance you anymore? They didn't enforce promises to pay when they were due. They simply renewed them without a payment of interest and no payments on principal. They had no security for the debt. They made no determination that the borrower was creditworthy. So there were none of the attributes of genuine debt, and therefore no bad debt deduction. The best you're going to do here is a capital loss, which is really useful to a corporation. Maybe someday they'll have a capital gain. But until then, the capital loss has no tax benefit. Next, let's talk about a set-aside approval for a private foundation that wants to accumulate its income for a period of years in order to make a special grant. Ordinarily, a private foundation must distribute its income or pay an excise tax. But in this letter ruling, the private foundation is granted permission to accumulate its money in order to make a matching grant that'll pick up to 1/3 the cost of project. Now, project is the rehabilitation of a historic structure. The set-aside will allow the private foundation to support an organization which is accumulating the money and to make this matching grant and give the organization some time to raise the money to qualify for the matching grant. We'll also give the private foundation an opportunity to control the long-term project. So an organization not affiliated with the private foundation, simply needing their money, is going to raise the money and get the matching grant. No one likes the proposed tax capital reporting by partnerships. Boy, that is an understatement. You could say this is not really a current event. The notice was published on January the 6th of 2020. That was a few months ago. But the drums have not stopped. The dissatisfaction with the idea of negative tax capital accounts, negative tax basis capital accounts, is so difficult for seasoned tax professionals to swallow that there's just been a lot of pushback. Let's talk about what the notice proposes. The notice proposes 2 new methods for reporting partner capital accounts on partnership returns for the purpose of tracking negative tax basis capital. Now you say, wait a minute, Lynn, those terms don't go together. You can't have you can have negative capital, but you can't have negative basis. Well, the IRS has figured out that you can. Where the partner contributes a fully depreciated building, let's say, to a partnership, and the partnership then borrows money using that building as collateral, and perhaps several years, 3, 4, 5 years from now, sells that building, and in the process is relieved of the debt, there should be a fairly significant calculation, a gain calculation, to that partner who contributed the fully depreciated building and who's had the benefit of financial statement depreciation in his capital account. This disconnect between a partner's basis for tax purposes and a partner's capital account. A partner's capital account is based on the fair market value of property in and property out, and income and distributions. So it is the fair market value of property in and property out that creates this difference between my capital account and my basis. But the IRS now conflates those two terms and conflates the consideration for the purpose of making sure that no partner avoids tax on the recapture of depreciation by contributing a building or some other depreciable asset to a partnership, which is then sold by the partnership. That's what this is all about. Sometimes it helps to know the why along with knowing the how and the what. So here's one of the methods, the modified outside basis method. For me, this is the easiest to understand. I determine the partner's basis using the traditional rules in subchapter K. That number can never be less than 0. We all know that. But I'm going to subtract from that basis number the partner's share of partnership liabilities under Section 752. So that if you had an immediate accounting and the partner was relieved of partnership liabilities, you could lose, you have a reporting of negative income, which wouldn't quite square with the basis and the capital account. And if I sound confused, it's because on some level I am. Because after you do those two steps, you have the partner's tax basis capital. And that number can be negative. So no one ever heard the term before 2017, and we were all taught that the capital account can never be negative, but my tax basis capital account can be negative. Next is the modified previously taxed capital method. And the IRS, in attempting to clear it up, I think may have made it even more confusing by giving us this second method of calculating a partner's tax basis capital. Calculate a hypothetical liquidation of the partnership using either fair market value GAAP or 704B, and you liquidate it selling all the assets for their fair market value for cash, right? So previously taxed capital is going to be the sum of the following amounts that would occur upon a disposition by the partnership of all of its assets in a fully taxable transaction for cash equal to the fair market value of the assets. 1. The amount of cash the partner would receive on a liquidation of the partnership following a hypothetical transaction increased by the amount of tax loss, including any remedial allocation, etc., that would be allocated to the partner from the hypothetical transaction, and decreased by the amount of tax gain, including any remedial allocations, etc. All liabilities are treated as non-recourse for the purposes of 1 and 2 above when you're determining gain or loss. But we're not done yet. Here's the example right out of the regulations. A and B are equal partners in AB LLC. Here's the balance sheet reflecting the following assets and liabilities. $500 of cash, inventory with a tax and book basis of $1,000, equipment, $500 tax and book basis, land, tax and book basis of $1,000, long-term loan of $5,000. That yields partners' capital accounts of $2,000. We know that a capital account can be negative. It can. I don't hear can't. A partner's capital can be negative. A partner's basis cannot be negative. So now what happens? Well, here's the explanation of the example. Using the previously taxed capital method and calculating liquidation values, gains and losses, based on the book basis of the assets, each of A and B's previously taxed capital under that method would be a negative $1,000. And then it goes on to explain why that is. But previously taxed capital can be taxed when depreciable property is disposed of and the partner is relieved of the partner's share of partnership debt. Again, if this sounds complicated, it's because it is. And we continue to have every week on the Thursday of every week, which seems to be comment day, since January, February, March, April, May, we are having comments every week from authorities that I respect that are finding fault with the concept of a negative tax basis capital account. But remember, it's an anti-abuse provision intended to stop a partner from avoiding tax on depreciation recapture when an asset is contributed to a partnership and subsequently disposed of or contributed to the partnership, places collateral for a loan, and then subsequently disposed of, and the only consideration is a reduction of the debt. I think I got that all in there. Well, that's it. Until next week. I really appreciate you joining me each week. I think maybe next week will be more exciting, less technical and more exciting. Please join me. If you have comments and suggestions, send an email. Meanwhile, stay safe.